Hello friends, welcome to this channel where I make complex banking and finance concepts easy for you. Now, if you are preparing for CAIIB exam, then today's session is very important for you. We are diving deep into a very important topic, that is change management from Advanced Business and Financial Management paper of CAIIB. Now, there are 6-7 key models in your syllabus. After this today, that is in this lecture, we will learn Lewin's change management model and McKinsey's 7S model, both of which are very important for your examination. So take notes, stay engaged, and let's get started. Now, before we jump into the models, let's understand why change management is so crucial in banking sector. Friends, banking is one of the most dynamic industries. New technologies, regulatory changes, and customer expectations keep evolving every now and then. Just look at how digital banking, UPI, and AI-driven services have transformed the way we operate. So to survive and grow in this environment, banks must also manage change very effectively. This is why change management models are important, not just for the CAIIB exams, but also for real-life banking operations as well. Now, there are many models of change management, but in your syllabus, you mainly have these 7 models. That is Lewin's change management model, then second is McKinsey's 7S model, then you have Kotter's change management principles, then nudge theory, Adker model, Bridges transition model, and finally Kubler's Ross 5-stage model. Now friends, don't miss any of these models. All these are very important for your examination and there is high probability of a question coming from any of these. Now let's take a deep dive into Kurt Lewin's change management model, which is one of the simplest yet most powerful framework for managing change in banks. Now this model consists of primarily 3 phases which can be understood with the help of ice block example. So just think of a block of ice. If you want to reshape it, what you will do? First you will melt it, that is unfreeze. And so this is the first phase of this model, that is prepare for change. Then next you will mold it, that is change will happen. And this is the second phase of this model, that is implement the change. And lastly you will freeze it again, that is refreeze. And this is the last phase of this model, that is stabilize the new process. So as you can see, 3 phases of this model of change management are, first is unfreeze, then change, and finally refreeze. Friends, this model is widely used in banks when they implement new regulations, adopt new technologies, restructure teams, or even change customer service processes. Next, let's understand each of these phases in depth. So first we have unfreeze, that is preparing for the change. Friends, this phase is all about preparing the bank's employees, customers, and stakeholders for change. That is, bankers must first recognize why change is needed. Now in banking, change could be triggered by first regulatory changes from RBI, for example KYC norms, Basel guidelines. Then next is technological advancement, for example CDS or digital lending platforms. Then next is mergers and acquisitions, for example SBI merging its associate banks or Bank of Baroda, Vijaya and Dena Bank merger. And finally for new customer demands, for example shift from physical banking to digital only services. So what are the key actions for bankers in the unfreeze stage? Now the first is identify the change and communicate its necessity. Friends, as you know, RBI might introduce a new guideline on loan provisioning and so management thus needs to communicate its impact. Then second is overcome resistance. Now as you know here, employees might resist moving from manual check processing to CTS based clearing. So banks need to conduct awareness program for the employees here. Then next is analyze risk and prepare a roadmap. Now here bankers should analyze, that is what challenges could arise or does the bank have the right technology, skills and policies. Now friends, the example of this phase can be transitioning from manual to centralized loan processing. Friends, suppose your bank decides to shift from branch level loan approvals to centralized loan processing system to improve efficiency and ensure standardized decision making. So what are the challenges faced by the employees here? First is branch managers and credit officers resisted the change as they were used to handling loans approval locally. Then second is employees might fear loss of control over decision making and longer processing times. And lastly, customers were concerned about delays and lack of personalized service since decisions were no longer made at branch level. So let's implement Lewin's model phase 1 here. That is unfreezing the system, which means preparing for the change. So what can banks do here? Now, first is senior management can explain the benefits, which are reduced errors, faster processing, and improved compliance. The second is bank may conduct training program to help branch staff understand how the new system works and their revised role in loan processing. And lastly, banks can introduce a phased rollout. That is first for home loans, then for SME loans, and so forth before full implementation. So friends, I hope this first phase of Lewin's model of change management is clear to you. Now, before moving ahead with the lecture, don't forget to get your CAIIB resources from the links given in description of this video. All these are hard copy 1000 series question banks of all the 4 papers delivered straight to your location, be it urban or rural, without any shipping charges. All the question banks comes with lots of numericals, case studies and questions which are very important for your examination. With this material, you get comprehensive exam level practice, and this makes you best prepared for coming CAIIB examination. All the links are there in description of this video, so do get these amazing hard copy books after you finish this lecture. Now let's continue with our lecture. The next phase of this model is change, that is implementing the change. So what happens here? Friends, once employees and stakeholders are prepared for the change, the actual transition takes place. Now, this is the most critical phase where banks introduce new processes, systems or regulations. So the key challenges faced in this phase are, first is employee feels confused and overwhelmed by the new systems. Then second is customers are hesitant to adopt new digital banking methods. And lastly, operation processes face glitches and delays if the transition is not smooth. Now, I remember when CBS was first implemented in my bank, then there was total chaos in branches. Branches could not even do day end by 11 p.m. at night for almost 2-3 days. And for many branches, it had to be done by IT department at HO. So, what are the key actions for bankers in this stage? Now, first is provide clear step-by-step guidance. Friends, here employees must receive hands-on training to handle new processes. Then second is ensured leadership support. Now here senior management must monitor and guide branch staff to prevent confusion. And lastly, regular feedback and troubleshooting must be there. That is, here constant support must be available to resolve any issues. Now the example of this phase in banking can be implementing UPI in the banks. Friends, when UPI was first introduced, banks had to completely revamp their payment infrastructure to integrate real-time transactions. Now the challenges faced were, first was employees lacked knowledge of UPI and couldn't guide the customers. Now second was customers were afraid of fraud and security risk. And lastly, banks had to upgrade their IT systems to handle real-time transactions securely. And so what were the steps taken during this change phase? Now the first was banks trained employees on how UPI transactions work. Then second was banks launched customer awareness campaigns on digital security. And lastly, banks partnered with fintech companies like PhonePe, Google Pay and Paytm to ensure seamless transactions. So friends, I hope you are clear with the second phase. Then next, the last phase of Lewin's change management model is, that is refreeze or making the change permanent. So what happens here? Friends, here the new processes becomes the new normal in the bank's functioning. Please note, without refreezing, employees might revert to old habits and customers might stop using the new system. So the key actions taken by the banks in refreeze stage are, first is reinforce new practices through incentives and recognition. Then second is embed the new system into SOPs and internal policies. And lastly, there must be continuous improvement based on feedback. Now, a practical example of this phase in banking can be moving from signature-based verification to biometric authentication. Friends, suppose a PSU bank introduces biometric authentication for customer transactions instead of signature-based verification. Now, the challenges faced can be, first, senior customers were unfamiliar with biometric systems. Then second is employees were reluctant to enforce the new rule. And lastly, some branches continued old practices out of habit. So how refreezing was achieved here? That is, this can be done by RBI mandating biometric authentication, making it non-optional. Then second is regular audits and monitoring. So here compliance teams must ensure full branch adoption. And lastly, by recognition and rewards. Here employees who actively helped in the transition are recognized and rewarded. So here key takeaway is that refreezing ensures that changes stick, as without it employees will revert back to old habits. So friends, with this I hope the Lewin's change management model is clear to you. Next we will do another model in this lecture, that is McKinsey's 7S model. Friends, the McKinsey's 7S model is a powerful tool that helps banks implement and manage the change effectively. Unlike Lewin's model, which focuses on the process of change, McKinsey's framework examines all critical elements that must align for successful transformation. This model is particularly useful in banking mergers, regulatory changes, digital transformation, and organizational restructuring. So the 7 elements of McKinsey's model are, now these 7 elements are categorized into 2 groups. First is hard elements, which are tangible and measurable, and this includes first is strategy, which includes the long-term direction of the bank. For example, a bank strategy to shift from branch-based banking to digital banking. Then second element is structure, which is the organization's hierarchy and reporting system. Now the example can be when PSU banks merge, their structures are reorganized, that is departments, leadership and reporting lines are also changed. Then third element is systems, which is the technology and processes followed by the bank. For example, implementing centralized loan processing system, upgrading the core banking system, etc. Then the second group of elements includes 4 elements, and these are categorized in soft elements. And these are categorized as soft elements, that is cultural and people oriented. So the fourth element of McKinsey's model is shared values, which are the guiding principles of the bank. For example, a bank prioritizing financial inclusion will invest more in rural banking initiatives. The next element is style, which is the leadership approach in implementing change. For example, a customer-centric bank adopts an open communication culture for better service delivery. Then next element is staff, which is the workforce and human resources. For example, upskilling employees when shifting to digital platforms. And last element is skills, which are the competencies of the workforce. For example, training employees in regulatory compliance, digital banking, and risk management. So friends, how banks use this model? Please note, when a bank undergoes a transformation like merger, digitization, or regulatory change, all the 4 elements must align to ensure smooth implementation. If even one factor is weak, the change will face resistance, delays, and failure. So let's understand this by applying McKinsey's 7S model in banking for the Bank of Baroda, Vijaya Bank and Dena Bank merger. Friends, in 2019, merger of Bank of Baroda, Vijaya Bank and Dena Bank was a significant restructuring in Indian banking. The McKinsey 7S model helps understand how this large-scale transformation was managed. So the first element is strategy. Now here the government aimed to create a stronger and more competitive public sector bank with enhanced financial stability and customer outreach. Now the merger required integrating 3 different banking structures, that is branch networks, leadership roles, and functional teams were reorganized for the efficiency. Then next is systems. Here the core banking platforms, loan processing systems, and digital banking services had to be unified to ensure seamless operations across all the 3 banks. The next element is shared values. Now, in this, the bank focused on a customer-first approach while maintaining employee stability and brand trust. That is, a unified corporate culture was developed. The next element is style. Friends, here the leadership played a crucial role in ensuring transparent communication, reducing employee anxiety, and managing customer expectations. Then, next element was staff. Friends, please note, in this merger, workforce integration was a challenge. So employees were reassigned, trained, and also given clarity on the job roles. And last element of the model is skills. Now in this merger, the reskilling initiatives were undertaken to help employees adapt to new banking technologies and merge operational frameworks. And once all these elements were aligned, we saw the outcome. As we saw, the merger resulted in a stronger, more competitive bank with enhanced financial stability, a larger customer base, and improved digital banking capabilities. So friends, with this, I hope the McKinsey 7S model is also clear to you. Next, we will do some conceptual exam level questions that have high probability of coming in your examination. A bank is implementing a new risk assessment framework based on revised RBI guidelines. Employees are hesitant due to lack of understanding of its necessity. According to Lewin's change management model, what should be the bank's first step? And these options are given to you. That is, first option is immediately enforce the new framework without consulting employees. Then second option is conduct training programs and explain the rationale behind the change. Then third option is introduce the new framework in a few branches first and gradually expand. And last option D is wait for the employees to adjust on their own without intervention. Now friends, this situation falls under the unfreeze phase of Lewin's model, where the goal is to prepare employees for the change and reduce resistance. As you know, employees often resist changes due to uncertainty and fear of unknown. So by conducting awareness programs, workshops, and open discussions, banks can make employees understand why the change is needed, its benefit, and how it aligns with regulatory requirements. So the correct option for the given question is option B. The next question is, a public sector bank is migrating from manual trade finance operations to a blockchain-based system for improving transparency and efficiency. According to Lewin's change model, what key factors should be ensured during the change phase? And these options are given to you. That is, first option is ensuring clear communication and leadership support throughout the transition. Then second is reverting to the old system if initial resistance is too high. Then third option C is relying solely on the IT team to manage the transition. And last option D is avoiding employee involvement to speed up the process. Friends, as we have learned that during the change phase, employees actively adapt to the new system. And proper guidance is essential. Here, strong leadership ensures a smooth transition by addressing concerns, providing hands-on training, and setting up help desks for employee queries. So the correct option for the given question is option A. Then the next question is, after a successful merger, a newly formed bank has completed branch restructuring and integrated core banking operations. However, some employees continue to follow old reporting structures and workflows. According to Lewin's change model, what steps should the bank take next? And these options are given to you. That is, first option is conduct refresher training and reinforce new workflows through updated SOPs. Then second option B is allow employees to continue using their old workflows if it makes them comfortable. Then third option C is return to pre-merger structure since resistance persists. And last option D is terminate employees who are resisting change. Now friends, this scenario presents the refreeze phase where the bank must ensure long-term stability and adherence to the new system. Resistance at this stage often occurs due to habit. So banks must reinforce the change through first is updated SOPs and policy guidelines, then next ongoing support through refresher training, and lastly by recognition and incentives for employees successfully adapting to the new system. So as far as this question goes, the correct option is option A. The next question is, a newly merged bank is facing operational insufficiencies due to inconsistent workflows across branches. While IT systems have been integrated, employees continue to follow old processes based on their previous bank norms. According to McKinsey 7S model, which element needs most attention? And these options are given to you. Now friends, the correct option for the given question is option C, that is structure. So please note the structure element of McKinsey's 7S model refers to hierarchy, reporting lines, and operational workflows within an organization. In the given case study, despite the integration of IT systems, employees are still following old procedures due to lack of a clear structural alignment. So the bank needs to ensure that roles, responsibilities, and decision-making processes are redefined post-merger to align all employees with the new system. So friends, I hope the question is clear to you. Then next question is, a bank is launching a digital lending platform and aims to ensure its staff actively promotes the product. However, employees are reluctant as they are more comfortable with traditional face-to-face loan processing. According to McKinsey 7S model, which elements should the bank focus on to drive change? And these options are given to you. Now friends, in the given case scenario, the bank's digital lending platform represents a strategic shift towards digital transformation. But its success depends upon whether employees embrace the change. So the best answer choice for the given question is option B, that is shared values and staff. Because in case of shared staff, the bank needs to instill a digital-first culture, ensuring employees believe in the importance of technology-driven lending. The next element is staff. So here employees need to be trained, incentivized, and motivated to promote and facilitate digital lending processes. So friends, with this we have reached the final question of our lecture, and the question is, a bank undergoes digital lending transformation implementing AI-driven fraud detection and automated risk assessment models. However, branch employees struggle to use these tools effectively, leading to delays and errors. Which element of McKinsey's 7S model is the primary concern? And these options are given to you. Friends, please note, while the bank has introduced advanced AI-driven fraud detection and risk assessment systems, its effectiveness depends upon how well the employees are trained to use these tools. So the correct option for the given question is option D here, that is skills. As we have learned earlier, that skills refers to the competencies of the workforce. In this question, the bank needs to provide extensive training to ensure the employees can confidently use the new AI tool for fraud detection and risk assessment. Without this, the transition to AI-based banking will fail. So friends, with this I wind up this lecture. I hope you found the lecture valuable, and if so, then don't miss to like and share this video in your community so that it benefits the most. Also, don't miss to get your CAIIB resources from the links given in description of this lecture. So thank you, and I will meet you again in another video next week.